This past Friday, we received the jobs data out of Canada and the United States. Both were disappointing. Jobs data in the United States, we were expecting just over 200,000 jobs created. We ended up seeing a number of about 187, 188,000 jobs created, below what was expected. Here in Canada, we were expecting about 20,000 jobs created. We actually saw a negative number. We haven't seen a negative number in a few months. Last month, we saw tremendous job growth. This month, negative 6,400 jobs. So that means we saw jobs being lost. What does this mean for the overall economy? What does this mean for central banks? Well, in my opinion, it just shows us once again that the economy is continuing to slow. Perhaps slowing in Canada, maybe even more than it is slowing or quicker than it is slowing in the United States. In the US, 187,000 jobs. That's kind of like what we call a Goldilocks scenario. Not too hot, not too cold, kind of just right. We were hoping for a number just below what they were expecting, and we got that number. And the market was really happy when we received that data out of the US. The market actually went higher on the open. In Canada, it's a number I think we were a little disappointed in. Yes, we didn't want to see a blowout number because that would mean that perhaps the central bank, Bank of Canada, may raise rates again to try and tame inflation, but we got a negative number. So now the worries are starting to shift to, are we getting closer to that recession, that mild recession that we all have been fearing since the start of the year? Are we getting closer to that mild recession that has been predicted by analysts, investors, and even the central bank? Bank of Canada has said that there was a 50-50 chance that we could go into some sort of recession. They said this at the start of the year. Our markets have been resilient here. Business has been resilient. The economy has stayed positive. But perhaps this negative number is one of the first signs that we could continue to see a slowdown into the fall and into the winter. So I believe this number is actually a positive for the markets in a what is good news is bad news, what is bad news, which we received is good news sort of way, because a slightly weaker number, especially out of the US, tells the central bank that what they're doing is obviously working. Low oil prices, supply chains now pretty good, a lot better than they were a year ago, and a higher interest rate environment is definitely helping to bring down inflation. We've seen inflation fall in the United States from above 9% all the way down to 3%. In Canada, above 8%, all the way down to under 3% on the headline number, 2.8%. Yes, core inflation is stubbornly high in that 4% range for both countries. But I believe that will continue to fall as well. And when we get the next inflation number out of the US, I'm confident that we could see a number with a 2 in front of it, just like we received here in our country, in Canada. So I believe that a slightly weaker than expected number in the US is a positive for the markets, because I believe the Fed may take a pause in the September meeting and maybe pause until their next meeting later in the fall. And I'm hopeful that we've possibly seen the last interest rate hike in the United States. Here in Canada, I am also hopeful that this rate hike in July will be the last one for this year as well. I don't know how quickly they're going to be cutting rates, but in my opinion, if they remain on hold, at least for the foreseeable future, and they don't speak about raising rates or a rising rate environment any longer, I think this will be a positive for the markets as we move into the fall and into November and December. Historically, we know November, December are good months for the year. So overall, jobs data definitely matters. We know central banks are looking at this jobs data, and it is very important for individual investors to consider or to watch before you make your investment decisions and design that portfolio that will meet your needs over time. We actually have a couple of charts that talk about or show us what's going on with the employment data. Our first chart here is on the Canadian unemployment rate. We'll see it here. We can pull it up. And you can see how the unemployment rate has slightly started to tick up towards the right-hand side of this chart. You can see how much the unemployment rate has come down since 2020. And now in 2023, it's been fairly flat and slightly ticking higher, which is what the Bank of Canada would like to see. in the United States, which is our next chart, a bar chart here, you could see the 187,000 jobs created, which again, on the low end of the scale here, you can see all the many months ahead of it or in front of it that were higher than that. We had some numbers well above 400,000 earlier. And overall, you could see that the pattern is definitely falling. Jobs numbers are definitely falling as we move ahead in time. And again, that's what the Federal Reserve would like to see. It's not what we want to see. Unfortunately, a higher unemployment rate means people are losing jobs, and that's not something we all want. But again, central banks are actually saying that it's okay if the unemployment rate were to rise a little bit because they believe inflation is the greater of the two evils. So slight uptick in unemployment and a slight downtick in inflation would be just what central banks want to see.